Good morning, everyone watching live on BAM YouTube. Let me know in the comments which market you are tuning in from. The Hot Sheet here on week 5 covers what you need to know about the real estate industry in a 24-hour time period. And on today's Hot Sheet, I will cover how rates reacted to Friday's job growth, housing market predictions from Altos Research, and the housing drag on GDP. Today is Monday, February 6, 2023, and the Hot Sheet starts now. If you tuned in to Friday's Hot Sheet, thank you as we closed out week 4. And our apologies. The internet out there in Las Vegas at the Cosmo on Friday morning was a little bit wonky. So if you were watching the Hot Sheet, you definitely noticed that. You can always listen to the replay on Spotify and on Apple. The audio was a little bit better. We are looking for a solution for when we're on the road to fix that lag. Maybe Elon can drop us off a Starlink every time we're on the road. But we're looking for a solution. We're going to get that fixed here. But appreciate you tuning in here as we start week 5. Hit the thumbs up. That's the best way to support this show. Share it with one person who wants a 24-hour look on housing each and every single day. All right, on Friday, we talked about that explosive job growth, over 500,000 new jobs reported in January. That beat estimates by over 300,000. Nobody was predicting this. Nobody saw it coming. There's not a Michael Burry example out there where it's like, yep, there's that one guy who said this was going to happen in the job market. It was absolutely abnormal and explosive, and the rates reacted to that. Okay, so when we were on Friday morning, we saw that the 10-year spiked up considerably, and I think we could all see what was going to happen to the 30-year. And by the end of the day, Friday, the 30-year had jumped up almost a quarter of a point. We had hit 599 on Thursday. Any LO that locked in a buyer on Thursday looks like a complete genius right now, because on Friday, it was back up to 6.2. So every time we touch this 5 mark, and Thursday's mark was the lowest since September 12, 2022. Every time we're like, okay, we're now at the 6 or high 5s, and maybe we can get into the 5s where many projections are coming in for 2023 and get into those mid 5s. We have something that pulls us back up, and we're sitting here at 6.19 today, according to Mortgage News Daily. And that's a direct impact from what happened with jobs. Let's get into the data. Job openings are, I don't know why that's not working. My apologies. Let's see here. I mean, we have the wonky internet, and now we've got the wonky screen share. Hold on here. All right. I can, if it's not going to, here it is. All right. According to Housing Wire, I'm reading from Housing Wire rather. Positive job reports send mortgage rates higher. So the job openings right now in this country are over 11 million. Okay, so we've got over 11 million job openings currently as we sit here today. Jobless claims under 200,000. The unemployment rate in America is 3.4%. We talked about that on Friday being the lowest level since 1969. You would just look at these numbers and be like, wow, in the history of U.S. economics, this is like an amazing situation, right? This should be great for the economy. Logan Mohtashami, who wrote the article, he projected we'd see 10 million job openings. It's 11 million. So he was pretty right. And this really would signal a strong economy, but the Fed did not like these numbers. They like some of the numbers. We're going to get to those in a little bit. But certainly the 10-year and the mortgage rates reacted to those. Okay. What numbers did they not like? And here's the thing about the 10-year. Okay. You see the 10-year, what happened last week, and that's why the interest rate went up so much. Every time we get down to this 3.4 marker for the 10-year yield, which happened on Thursday, right? Happened on Wednesday and Thursday after we had a great inflation report. We had a great meeting from the FOMC. Every time we get to that mark, something pulls us back up. We get below that 3.42 mark that's referenced here in the article, we're going to actually see a 30-year fixed rate that lives below 6 and into the 5s, a little bit deeper than 5.99, which we saw on Thursday. So that's the mark that we're trying to break. We haven't broken below it yet. Why are we not at, as Logan puts it, a 10-year yield that is at 4.25 and mortgage rates near 8? Because you would expect that the Fed hated this job report so much that everything would have just completely went the other direction. We would have set ourselves back 6 months ago. Well, what they do like is the employment cost index. You can see here on this chart, we're continuing to trend in the right direction. Also, the United States average hourly earnings year over year. Okay, so you can see that January 2023 is our lowest mark in the last year. The Fed wants to cool down wage growth considerably. The more money people have to spend, the bigger the chance inflation has to continue to increase. The Fed's mission is obviously to get that down to 2%. So they want to slow down wage growth. We've been continuing to add jobs and slowing wage growth at the same time. So that was kind of the silver lining in these Friday job report that might help us here if that continues to be the case in February. We haven't seen this explosion of job layoffs here in January. We've seen a trickling of layoffs, and obviously the demand for jobs has quickly taken care of that, so that we don't have we're at this all-time low unemployment. But we want to continue to see job wage growth rather cool. Obviously, if you're looking for a job or you're looking for a raise, that doesn't sound good to you, but that's the reality of the economy. What the Fed would probably do over the next couple of years over the course of this year would impact the next couple of years to a greater degree than any raises that could happen across the country. So Logan believes the labor market is fine and that wage growth is slowing down. We don't need to create a recession to bring down inflation. Let me know in the comments if you agree with that. We don't need a recession to bring down inflation. Someone would disagree with that. We just need more time, more supply. We know we need housing supply for sure. The best way to deal with inflation is always with supply, because demand destruction tends to hit future supply production. It depends on how competitive these companies are going to be with these 11 million job openings, right? Labor participation went up a little bit, but there's seemingly still a whole bunch of younger people that could be employed that are sitting out of the market for whatever. The great resignation is a great trend for some people. It doesn't make much sense, and maybe you're going to see some more of those come back to work, pick up those jobs. Hopefully we just continue to see this job growth cooling. But we are now in a situation here this week where we seem to be further away from 5% mortgage rates. The 10-year today is up again. We'll get to that at the end of the show, show you exactly where that is. I don't expect the 30-year fix to touch the fives again this week. There's no indication that we could support that. Okay, Altos Research, which is owned by Housing Wire, has their market predictions out for 2023. Let's go through each one of them. Mortgage rates, inventory, and pricing, what they think for mortgage rates. So their data shows mortgage rates are going to be key this year. Obviously, if economic conditions cause rates to jump over 7%, expect buyers to sit on the sidelines, allowing active inventory to build and time to sell a home. On the other hand, if rates slide under 6%, which we just talked about, we can already see that buyers are eager. I mean, this is like a duh, Altos. Thanks for pointing this out. We already know this from last year, right? We saw that what happened in Q3 of 2022 when mortgage rates went up over 7%. We had what I call the Cold War of real estate. Everybody went to the sidelines. That's both sellers and buyers alike. And when we've touched to 6 and under 6% this year, we've seen mortgage applications pop. We've seen median price points across this country where there's a competitive environment again. There's multiple offers. So a big duh there. Anybody could have pointed that out that just was paying attention the last 6 months. Let's see what Altos says about inventory. In late January, there were 465,000 single-family homes on the market across the country. That's 36% fewer homes for sale than the numbers we had prior to the pandemic. Okay, so for all these, I'm getting really fed up, and there's one channel in particular on YouTube that I think I'm going to have to do a deep dive onto, because the guy's been saying the same thing since 2020, to 2021, market crash, inventory, all these different, scare tactics. And the comments are just like, oh, you're amazing. You're so smart. You're so brilliant, because now we're starting to see some signs of a cooling market. It's like, hello, you dummies were watching these same videos for the last 3 years. He was convincing you not to buy in 2021. In 2021, you would have bought a house for 40% less than today. You'd be locked into a 3% interest rate. Everybody that bought in 2021 is thrilled with their decision. Heck, the market could go down 20% and interest rates could do whatever the heck they want, and those people are still winners. So it's just absolutely insane to me, some of the advice that's going on. And the reality, while inventory has gone up considerably from 2022, it's not anywhere close to pre-pandemic. We're 36% fewer properties for sale than pre-pandemic. We're still at a very low inventory level. Yes, early 2022, we were in the 200,000s for single family homes, and we're in the 400,000s for single families right now. So Altos expect inventory to start climbing in February, peaking for the year in late summer, and ending 2023 with fewer than 700,000 homes on the market. We'd like to get that number up. Of course, it's going to help affordability for sure. It's going to keep the Fed off of the housing markets back. If we've got more options and more inventory, then prices aren't going to get out of control. If we've got more median priced homes coming onto the market, then that would certainly keep some of these prices from getting out of control. So we should start to see more inventory in February. That remains to be seen. I'm looking for what the inventory levels look like from the last week. That'll be some point later this week. Okay, then pricing. The median price point in just for January was $414,900. It's higher than the median price point from 2022 from this point. So, everyone talking about prices dropping. Well, there you go. Median price point just for that month is a little bit higher. The price trending we are most interested in right now is the median price of new listings each week. Okay, so that's going to hopefully indicate, as long as we don't outbid these prices, what some of these closings will be over the next couple months. And the median price of new listings is currently $379,900. So that's a little bit more of a healthy level than what we saw in January 2022. The new listing price was skyrocketing week over week as sellers knew that buyers were bidding on everything very quickly. We don't want to see that situation this spring. We'd like to see inventory come onto the market at a much faster pace this year so that doesn't happen, right? This is something that, you want to, hey, if the expectation is we're going to see, as Logan says, more inventory late February, if you're a seller, if you're advising a seller in this housing market, you want to get on now. You're actually more likely to get a price closer to January than, hey, if new listings are coming on at 379 now, when those close out in 2 months, that's going to be, a potential decline in the price that you can get depending on when you list your home. Okay, currently 33.9. Here's the other thing. You're hearing this a lot on YouTube right now from some of these doom and gloom people. They give me a headache. They're saying that price reductions are skyrocketing. They are soaring. Currently, 33.9% of properties on the market have taken price reductions in 2023. But this number is dropping. This number is dropping. It is not skyrocketing. Okay. It went up in quarter 3 and quarter 4 for sure. It went up. It went up from, by the way, like 0 because there were no price reductions happening before quarter 3 and quarter 4 for the last 2 years before that. So yeah, it went up. And now, as we sit here, listen, a lot of these people are going off of quarter 4 data. This is why the hot sheet's so important. Hit the thumbs up if you agree. I'm going to give you up to the minute 24 hours, just like your MLS does in your local market. What's happening in the last 24 hours with all the data available? Well, all these people making YouTube videos, they're referencing December, they're referencing November, and they're saying, wow, price reductions are skyrocketing. No, since January 1st, that number's actually dropping. 33.9% of properties in the market have taken reductions in 2023. The number's dropping. It's a little bit higher than the usual 30%. Typical years, it's right next to the 30%. It's way lower than the 43% we saw in quarter 4. So stop referencing quarter 4 numbers and get your data updated. This is one data point illustrating a bit of surprising turnaround in buyer demand. Okay. So if you're talking to a buyer, if you're talking to a seller, this is information on both sides that they need to know. If you're talking to a buyer and you're like, well, hey, this guy on TikTok, this guy on YouTube tells me, these price reductions are just skyrocketing. I'm going to wait a couple months because the price reductions are going to get even bigger. No, in the spring market, they're going to get smaller. We're probably going to drop under 30% would be my prediction for price reductions across the country. Are you talking about real estate mindset? I have not. Don't even get me going. I'll go check out real estate mindset. I just challenged somebody to a debate. I think it's called Reventure or something. Dude's got a huge following, but all he does is pump. It's been 3 years straight of pumping. The market is crashing. Talked to a lot of people out of buying in 2021. And I did challenge him to a debate to go long form podcast. Any of these people who have been saying for 3 years straight and now want to run around and say that they're right about a housing market crash, I want to do a debate live on BAM. Because they led a lot of people down the wrong path in 2021 for sure. Hurt a lot of people that are still just going to be waiting. One of the comments after I made a comment on this guy's YouTube video, one of the commenters that agree with me is like, yeah, back in the 80s, people were waiting and they're still waiting today to buy. They're still living in an apartment. Yeah, we need another debate for sure. I agree with that. I love my debates. Been trying to mix up one, Debate is not a bad word. Let me know in the comments if you agree with me. Debate is healthy in this environment. We should be having more long-form discussions. Okay, so unless mortgage rates spike above 7% consistently in the next few months, and listen, as much optimism as I have and as much optimism is out there for these rates to eventually get below 6 and stick into the 5s, there is still a possibility that we get back up over 7 like we saw last year. The last 6 months of this year are a lot more fuzzy to me than the first 6 months. And we get back above 7, we know what happens when we get there. Okay, we know that buyer demand cools significantly because we tested that out last year when we popped up over 7. And it's still a possibility. Okay, so 6% is still pretty advantageous for buyers. If you're waiting for the perfect 5.75, 5.5, you might miss it. There's still some uncertainty that we get there. I'm optimistic, but there's still enough uncertainty that we get into the 5s, and we certainly could go the other direction. We're going to see what happens with the FOMC meeting in March. We're going to see what happens over the course of this month. I'm looking forward to this week. What happened with mortgage applications? What happened with inventory over the last week? These are all trend lines that are important for us to follow up to the minute and not going off of old data like a whole bunch of other people want to do. Unless mortgage rates spike above 7% consistently in the next few months, it seems unlikely that home prices will drop substantially in 2023. Contrary to what all these other people want to be pumping out there. So, be aware of some of this crap that's flowing around out there. This is pretty solid data across the board from what we're seeing from, the majority of folks that have a really good feel for the market and aren't just trying to scare people. But be aware that if whatever job you have in housing, some of your clients, some of the people you're advising and consulting might be hearing the other side of it. And you want to make sure you get out ahead of that. Certainly with your database, you want to be putting out information that relates to what they're seeing into your housing market into your local housing market every single day. Okay. Really interesting tweet that I saw from @News Lambert, Lance Lambert from Fortune. And he's a great follow on Twitter. I've talked about him before. Okay. I'm going to bring up the tweet. And the reason why I'm bringing this was, he tweeted this in the last 24 hours. Reason why I thought this was so interesting is this is the same exact headline as a headline in 2012. Interesting. 2012 was obviously the end of the last housing recession, which lasted seemingly forever from 2007 to 2012. If you're with me on that one, let me know in the comments or hit the thumbs up. All right. News Lambert. Goldman Sachs reports the total drag from housing on GDP growth after including residential fixed investment already peaked in 2022 quarter 4 at 1.1 percentage points. Already peaked in Q4. Okay, so that was the the worst of the worst for what we're seeing right now, and will moderate to just 0.25 percentage points by 2023 Q4, averaging a half a percentage point throughout 2023. Here's the chart. You can get this down below. All our sources and charts you can grab down below in our daily download link. And here's what they consider the peak right here. That's Q4 of 2022. And you can see the trend line contribution of housing to quarterly annualized real GDP growth. Okay, interesting. But here's what I think is fascinating. Okay, according to Forbes, back in 2012, this is November 12th, 2012, this article. Housing no longer a drag on GDP as recovery solidifies. The same Goldman Sachs says. Okay, housing has turned the corner, according to Goldman Sachs. We're going back to yesteryear right now, 2012. Stick with me. Goldman Sachs economic research team, and has gone from being a drag on GDP to a tailwind, rising prices, rebounding household formation, and the normalization of housing starts over the next 4 years should keep upward pressure on the housing market. So back in 2012, if you remember what was going on there, we bottomed out. Housing bottomed it had like a double bottom, like 09, and then we had like a little investor spike and then bottomed again in 2011, 2012. When they saw this report that housing is no longer a drag on GDP, according to Goldman Sachs, they said, well, this is really positive because the rest of the economy was really struggling in 2020, 2012. So this could help. This could be a tailwind for GDP. Well, we know today that the Fed doesn't necessarily want this tailwind, right? It's like such a balancing act. The Fed wants us to be positive GDP, but not that much. We don't want that much because that means inflation is going to go the other way. We've seen disinflation for the first time. We want it to continue to trend downward. So this is very interesting because we're not anywhere close to what we had in 2012. In 2012, we wanted this tailwind. Do we necessarily want the tailwind, or how extreme do we want it? We want a more normal, flat, stabilized housing market. We want affordability to come down. These are things we definitely want. And as we talked about at the top of the show, I'm more concerned about what the Fed's reaction, because we saw just in a 24-hour turnaround what happened to the bond market and to all the markets, right? Stocks have been down after you saw that job report. We don't want to see jobs get so far ahead. We don't want to see another 500,000 jobs in February. Logan wrote that in his article. He doesn't expect that. You start seeing that the norm, you're going to start talking about a job market bubble, and you're going to be back into 7% 30-year fix. So I'm more concerned about that. But I did think that little comparison to the GDP from today till now was interesting. Same headline from Goldman, but do we necessarily want housing being a strong tailwind on GDP? Not so sure about that as we sit here and we're worried about what the Fed's next moves are going to be. Okay, let's take a look at where we're at to the minute I'm going to do a refresh and we'll see where we are. The minute on the 10-year Treasury, we're up to 3.625. Okay, so it's continuing to kind of trickle up since those job reports came out on Friday. We definitely want to get back into that under 3.5 mark, into the 3.4s. We know the closer we get to 3.4, the closer we get to 5.99 on the 30-year fixed. And if we could break 3.4, we'd be living in the fives here for the 30-year fixed mortgage rate. We did end the week again at 6.19 after touching down on Thursday at 5.99. I don't expect this number to go down today. If anything, I would anticipate the 30-year fixed mortgage to go up today. Later today here on BAM YouTube, make sure to subscribe so you don't ever miss anything. We've got an Over Ask podcast premiering at 11 a.m. Eastern time about building a local community if you're a real estate professional. Also, down below, we've got a link to our AI Tools for Real Estate Agents ebook. That's a 38-page ebook. Absolutely free, absolutely a winner, the best AI ebook ever created on planet Earth, certainly as it relates to real estate. And on Wednesday, right here on this channel at 4 p.m. Eastern, we have another live cold call event that you do not want to miss. The last one was iconic. By popular demand, we are doing another one here this Wednesday. All right, appreciate you guys. Let's have a great week. We'll see you back here tomorrow, 9:30 Eastern on the hot sheet. Until then, toodaloo.